Everyone, welcome to another edition of VC Wisdom Podcast. Today with us, we have Steve Valentor. He is founder and president at Polynomial Venture. Steve, can you quickly introduce yourself and tell us a bit more about Polynomial?
Sure. Well, thanks, Charles. Thanks for having me on the podcast today. I appreciate it. So I started Polynomial Ventures to exploit a mathematical analysis I discovered in studying the valuation of companies, and I found that if you evaluate them in a certain way, you can create a polynomial, and that can be used to really optimize the valuations of these companies. So my background is decades in tech. I was a computer engineer for a long time, semiconductors, personal computers, semiconductors, and then aerospace computers. Then I moved into finance and came up with this idea. Also, I teach entrepreneurship at DePaul University.
Do a lot of things. Students often ask you questions about like how they should start and so forth. What advice do you give to them?
Well, actually, that's exactly what we do. The courses that I teach is a series of courses for sophomore level students. And the first one is how to come up with creative ideas to start a business. The second is how to actually form and start a business. The third one is how to raise money and finance the business. And then the fourth one is, now that you've done all of that, how do you manage the business and set it up with infrastructure so that it can grow?
Love it. Do you often recommend students go for VC capital, or should they actually start to bootstrap and understand the physics of business before asking capital?
Yeah, definitely. Venture capital is not appropriate for the vast majority of businesses that are started. A lot of people don't really understand this. For venture capital to work, it has to have massive growth in the businesses. And when a VC is picking businesses to invest in, they can't really predict. Some people perhaps can, but I can't predict which ones are going to succeed and which ones are not. I know that they all have a better chance once they've had a venture investment, but still, since you don't know which ones are going to succeed, you really need big winners. I mean, you need to have an Uber, a Google, WeWork, one of these things. And so every business that you invest in has to have that potential. The vast majority of businesses that are started don't have those kind of potentials. When somebody starts a liquor store, or a beauty parlor, or an auto repair shop, it should not be looking for venture capital. That's just not a fit. When somebody has a multi-billion-dollar total available market and they've got a new way to approach that market, that's when they should be looking for venture capital. But as you know, the basic process is the entrepreneur comes up with an idea. They fund it themselves up to a point where they can establish that the idea can work. Maybe they need a prototype. Maybe they need to explore, do some market research and figure out how they're going to sell it. Then they'll go and they'll raise money from friends and family, and that will get them a little bit further along. Then they may go to the angel community or to wealthy relatives and try to raise money there. And only after that, when a company has generated traction and it has a multi-billion-dollar potential, then it might be a candidate for venture. And even then, only 5%, maybe even fewer than 5% of the companies that present to venture capital are going to be selected for investment. But once they have a pretty good chance of succeeding now, because they're going to get not only the money that they need, because it takes money to make money, but they're also going to get the kind of professional institutional advice that they need to have to grow that company, to put the infrastructure in place to make it successful.
Love it. And yeah, I love comparing it to the wave mechanics. It's just hard sometimes because you need to see the tsunami coming, right? And that's the kind of science, which is why me on my side, I'm developing this kind of incubator or startup studio in which I test various startup ideas at the same time. And when the physics are there, when I see that there's a bunch of customers and I need to add fuel on the fire, I think this is when I would ask for not a lot of string attached capital to just put fuel on the fire and ride that wave that might slow down up until sometimes. In the case of Uber, which it's also very rocket science, because it's kind of easy to, me personally, I'm a futurist and an early adopter. So it's like I had a need to, order a cab on my cell phone or order my grocery. I can remember ordering groceries back in 2018 in Rappi in South America and in Mexico City, actually. And it was like all kind of broken up approach. And I was probably one of the 50 early users of the app. So I knew that by then. But the question is, how do these companies, one, know that? Maybe they have hypothesis, but two, they also, I think they have an idea, they ask for capital, and then they invest a lot of this capital to also educate the market and create their own market, which makes it kind of very complex to know if something is going to succeed or not. Most actually ask for money to test hypothesis vs using the methodology that I use, which is getting traction and then asking for money. So what is your opinion on that? And as a VC, do you invest in startup studios like that, in proven ideas, or do you also like making wild bets from all the stats that you have, all of your own thesis, and saying, okay, I'm betting on that one, there's a 5% probability of success, but if it does, it's going to be 100x return?
Yeah, well, first of all, it has to have that really high potential, because the reason I mentioned earlier is you can't predict which one will succeed. So the first test for what I look for is, does a company have the potential to really be huge in a market? I also like, there's a couple of things that you mentioned in there that I want to comment on. One is wave mechanics. As a mathematician and a physicist, before I moved into this computer stuff, wave mechanics is really interesting to me. When you take a wave and you have another wave and the two waves come together, they either add together and make a giant wave, or they completely cancel each other and make no wave whatsoever. So being able to recognize where what you'd look for in the analogy here, what you'd look for is the likelihood, based on the nature of the wave that is being created, as the sort of semaphore for what the entrepreneur is up to. Yeah. Is that something that is likely to combine with existing waves and create something much bigger or greater, or is it likely to be just canceled out and washed away? So that's one thing to look for. This other thing that you mentioned, I think, is really important point. Traction and demonstrating how something works. In one of the startups that I'm involved in, it's a really, really great idea. It's an alternative to dental insurance. Most people would agree dental insurance is a kind of a bad thing. Insurance works really great when you have a giant population and a small subset suffers a catastrophic loss. Well, that never applies to dentistry, because everybody needs to go 100%. And the loss is never catastrophic. So you take that and you say, okay, well, that's something that could be sold. That's important to patients. It's important to doctors. But how do you go out to sell that? So our first idea with that company was, we're going to sell it to doctors because they get the biggest benefit, and they're going to love it so much they'll sell it to patients. They love it, but they don't sell it to patients. The nature of their business, if you go into a busy dentist's office, you'll see that the drill is running and the doctor is going from chair to chair to chair with assistants setting up those patients. So they don't have time to go explain a better solution to how to pay dentistry. They're in that office to run their drill and earn their money. So we couldn't sell it to the doctors. That didn't work. So then we said, okay, let's sell it to the patients. Well, that's consumer stuff. So now you need Super Bowl ads, and you need just a huge amount of money to go sell it to consumers. And we didn't have the money to do that. So then we said, all right, let's sell it to employers. Well, when you go to employers, the employers say, I like the idea, but dental benefits are this much of my expense. This is my expense for employee benefits. So if you want to talk to me about benefits, solve the whole problem for me, not a tiny little portion of it. And so then we said, okay, well, now we need to get somebody who sells that whole solution, the brokers. Well, now you've got to go approach the broker industry. And then what you find out is that they get 10% commission. So now I've got a great idea and I've got all kinds of people who want it, and I don't have any proven mechanism to deliver it. And so if somebody comes to me for an investment at that point, then I say, what am I investing in? Am I trying to help you find a problem to fit the solution that you've created? Or am I trying to fund your growth once you've already found a solution to the problem, or that you found a problem to the solution that you've created? And we need to be very, very careful and this is why I would encourage the entrepreneurs to say, go out and find a traction point, even if you can't afford to scale it, but find one. In our case, had we found, if that worked, if we exposed it to a dentist and they bought it and they sold it to a lot of patients, then we'd say, now we have a traction point. Now what we need to do is to pour some cash on that little spark and turn it into a big fire. But that didn't work. So I look for, and actually I watched a video with Guy Kawasaki last week where he was doing a lecture at Stanford talking to senior MBA students about how to approach VCs. And he said, hey, sales is the thing. It doesn't matter that you have a great idea. It doesn't matter that you're going to change the world. What matters is that you found a way to sell it, that you've got customers willing to buy it. And once you have that, now we can help you to scale it by putting money in, by injecting money. But the founder, the entrepreneur needs to be finding that way to sell it all the time and constantly finding new ways to sell it.
Yeah, with all the AI development, and people talking about replacement, the founder is such a unique creature that is so hard to replace. And same for the VC, because the VC is analyzing what the founder's output is and making predictions into the future, which is a very hard thing to do and depends on a lot of factors. And yeah, do you often make decisions from the gut level? Do you consult people before making an investment? I want to know about your process. We've heard about Bloomberg GPT lately, which is this algorithm, this GPT that will actually help you to make a decision. And finally, there might be this VC GPT, which might help you make a decision on a startup. If there would be such a VC GPT, what would it look like? How would it help you make a decision? And what factor would it base itself upon to help you invest in the right startup all the time?
Yeah, well, artificial intelligence is a topic we should schedule a separate podcast for, because I can go on for hours on that one. My basic thinking on it is much of what we do in venture and in any business analysis is numerical analysis. You do have to make sure that numbers and ratios make sense. And I'll give you some insight into the formula that I would use to do an assessment. But artificial intelligence is extremely formulaic. When we do that longer podcast on artificial intelligence, I'm going to put forth the postulate that it isn't really intelligence at all. It's really just data processing, and it just is being done on faster and more capable machines with bigger databases and faster access. And so we can allow it to fool us into thinking that it is really doing complex thought like we are, but it's not really, in my view. It's really just doing data processing. But data processing is a big, big part of this. And let me explain. So what I would look for scaling a business, for finding a business that can scale, first of all, you look for, is the TAM big enough? Can it be $1 billion company? And if it is going to be $1 billion company, it's probably not going to completely create a new industry. It's probably going to be similar to another company or group of companies that has succeeded in a similar industry before. somebody like Warren Buffett would say, they're all the same. They have a good idea. They have an efficient business model where they take in more money than they spend, and then they accumulate profits and they grow. And if they continue to grow and build a nice moat around their idea, then it can grow. So take that and scale it all the way down to a small company and try to do the same thing. So I would look at what market are you going to go in? Like, for example, the dental insurance alternative. If you look at that when you say, what does that look like? What other companies might look like that? So it's at the lowest level, what that is doing is taking an existing service and an existing customer and putting them together in a little more efficient way. So let's look at another company that has done that. A great example of that is Priceline. So they have taken hotel rooms, flights, rental cars, and they've delivered them to travelers. And they've done it in a new, more efficient way. So then I would say, okay, let's analyze they're a public company. So you can look at their financial statements and you can look at their income statement, their balance sheet, and their cash flow. And now analyze those a little bit and say, what do those things actually look like? How much money goes in? How much? What is their cost of goods sold? What is their expenses look like? And then what does their bottom line look like? And is that something that can deliver the kind of percentage? I would say that any venture deal should be looking for a minimum of 15% EBITDA or earnings before interest, tax, and everything else. It's got to be finding a business. You don't want to go into a retail business that has a 2 or 3% earnings. I don't even understand how grocery stores can make money. There's so little margin. So the first thing is it a high margin business? Can you find another business that you can analyze their financial statements? Then once you've done that, and in this case, I've got this dental insurance alternative, and I've got Priceline. So Priceline, when they report their revenue, they don't count the price of the hotel room, the airfare, the rental car, the actual thing that they're selling. They only count as the revenue their little incremental margin that they're putting on there. And so now you say, okay, well, they may be handling enormous amounts of money, but their business is only a small subset of that. Now let's analyze that. What is their revenue? What are their cost of goods? What is their expenses? And do they have a gross margin of 50 or 60 or 70%? And then when you remove expenses, they get down to 15 or so percent. Well, yes, yeah, it does look like they can do that. So now let's take a look at the same level, at that very cursory analysis. Let's look at our company. Does it do the same thing? Yeah, it does. It's only taking a small fee against that giant revenue that's being spent. In the case of dentistry, by the way, we Americans spend $142 billion, $142 billion on dental care every year. That's a big, big, big market. But this little alternative to insurance works on a small little 5% of that. So now you say, okay, well, my revenue is only tiny, but I can go back and look at this alternative. And let's not stop at just simply the top level analysis. So you do there's about 5 or 6 real easy ratios. Price to earnings ratio, return on equity, return on investment, profit margin, gross margin and net margin, and EBITDA margin. Those are all real easy. Everybody knows about those. But here's something you probably didn't know. Accountants have come up with about 50 ratios. So if you take these 50 ratios now, it becomes a much more complex problem. But you can do those 50 ratios for the publicly traded company just from their financial statements. You can do those for your portfolio company. And now you can start to see levels of comparison that are not readily available and are not apparent. And you could certainly use an artificial intelligence like a very sophisticated data processing tool to do that analysis. And you say, hey, when I do that analysis, does my portfolio company still hold up to this publicly traded company that I've already seen succeeding? And if it does, and that's the kind of analysis that we do, we actually call that our polynomial, because when you take all of these ratios and you put them together in an equation. You have a ratio with a coefficient in front of it. You put an equal sign in the middle. You have your portfolio company on one side and your industry average or reference or prospective acquirer even on the other side, and you build this polynomial, you can solve it. So yes, I do think that a sophisticated data processing, call it AI algorithm, could really help. But it is never going to, well, I can't say never. In the near term, it's not going to be a substitute for judging, is the entrepreneur truly driven? Are they going to not give up on this idea no matter what bad stuff happens to them? And many, many bad things will happen to every entrepreneur every day. I saw a short interview with Elon Musk a few weeks ago, and he said, being a business manager, being an entrepreneur is a horrible job. He said, it doesn't matter at what level. He said, you have to, from the moment you wake up till the moment you go to bed, you've got to live and eat and sleep and do that business and do nothing else. He said, when Tesla was going through the Model 3 debacle and he needed to go sleep on the floor, be there 24 hours a day, he said, working for someone else is very easy. Being an entrepreneur, being the person in charge is a horrible job. And it's only worth it if you really want to succeed. So how would we use VC GPT or some kind of algorithm like this to assess how a person is going to react when the world is crumbling on top of them and they can't see a way out, but you know, they're going to survive anyway? That's part of the art that has to be assessed by the VC. Is does this person have the wherewithal to sleep on the factory floor until the problem's solved and make it happen?
Yeah, I love it. Two thoughts here, and yes, we definitely need to make a round two because we only scratch the surface here. But one, every entrepreneurs are going to have their AIs, you know, and these AIs are going to be part of them. They're going to be custom AIs, so they won't necessarily need now to do more time. Although biologically, we're also going to crack the sleep problem, and we're going to be biologically engineered. So that could also help. But if you have me as a CEO of your business or as the founder that you invest in, I'm going to come with my AIs, you know, I'm going to have a various AIs. I'm going to say, okay, I come with package 5.6 of GPT-21, and here I have Midjourney version 21.4. Will I pay for these? Probably. Will they even take equity out of my businesses? Probably. In a pre UBI world. The second thought I have for you, that one is more short term, is that you're going to be able to plug in my own Charles algorithm. So you, for example, I'm a very public person on my Twitter, on my LinkedIn, and whether I want some data to be private, for example, about my health and so forth, you're going to be able to plug in that algorithm as a VC, and that's going to tell you, okay, Charles is 65% reliable. Charles is really good at that, and I think that's going to highly minimize your risk. But like two little ideas I wanted to throw your way there, and that's a great company idea, right? An algorithm that would literally tell you who I am in reality as an investment, as a business person, and my real output, right? There wouldn't be like no bullshit of me claiming that I'm the best at that. It would really be like accurate data or somewhat accurate data. Steve, that was very entertaining. I love your brain, your mathematician brain, and your background and all of that. So we need to make a version 2.0 of that, but where can people find out more about you until then?
Well, the first thing is I'm on LinkedIn. I'm quite active on LinkedIn. Fairly formal there, Stephen R. Valentor on LinkedIn. Polynomial Ventures is the word polynomial-vc.com. So POLYNOMIAL-VC.com. And I'm also on Twitter, but I apologize, I don't know what my Twitter handle. It has my name in it. I think it's S Valentor or something like that. Yeah. But I'm LinkedIn is probably the best place. I'm on LinkedIn every day, and that's probably the best place to find me.
All right, love it. Yeah, if people just Google Steve Valentor Twitter, they'll find you. So thank you so much.